Let's be careful out there.
Let's be careful out there.
And hey! Let's be careful out there.
Markets run on narratives. They need stories to help explain price action. Equities are rallying because of generative AI and the profits we're going to see in the future. Equity markets are falling because of recession fears. The smart machine at Quant Insight helps shine a light on which story is most relevant on any given trading day. And most of the time, we're focused on macro stories, but sometimes it's equally as important to look at those times when macro is not driving market. This chart shows the QI vol indicator in orange versus VIX in grey. VIX is the equity market's fear gauge. It's currently below 20, and historically that means equity markets are calm. Readings above 30 tend to reflect high volatility. They reflect heightened stress. Institutional investors watch VIX closely to gauge the mood of the equity market. So what jumps out from this chart is how the QI vol indicator often gives an early warning ahead of spikes in VIX. It doesn't always work. There are some false signals, but over time you can see that we tend to lead and preempt sharp moves in equity volatility. So what is the QI vol indicator? We take our model confidence, which measures how good a job the model is doing at explaining price action. We look at model confidence across global equity, bond, and currency markets. When the index is low, macro is doing a very good job at explaining price moves. When it is high, something else other than macro is driving financial markets. What could that be? Typically, it'll be shifts in investor positioning, swings in sentiment, or maybe geopolitical shocks. So sharp spikes in the vol indicator shows the macro story is losing its grip, and this other stuff is becoming more important. The thing is, positioning, sentiment, politics, they're typically noisier than macro fundamentals. So when these things are driving markets, then markets are more volatile. So long story short, when the vol index rises, it's a red flag that we may be about to face a period of heightened uncertainty. It's an early warning sign that investors should consider playing defense rather than offense.